Good morning and welcome everyone to our webinar series. Today's topic is key benefits compliance issues during the health crisis. We hope that wherever you are attending this morning, you are safe and well. And in case your days have run together, today is Tuesday, April the 21st. As Jason mentioned, my name is John Cobble, and along with Laura Bibb and Jason Cogdell, we will be covering many topics today, so we're going to split it all up. You'll see some of the things that we're planning to cover on the screen now, and as always, please feel free to submit your questions throughout the presentation. We will answer those that we can or follow up with you directly, particularly if there are any specific issues. We'll be glad to reach back out to you and address those. As a reminder of our resources that are available, we are posting the information that we have on our website homepage. It's right up at the top of probenefits.com with a link directly to COVID issues, so you should be able to find that. And we also have additional training materials that are available on specific topics, and as always, we're available by phone or email to assist you with any of your specific questions or just general questions. We'll be glad to help. To start things off, I'm going to turn things over to Laura Bibb. She's going to present a summary of new legislation that has recently come out.
Thanks, John. The first legislative update that I want to share with you all is the CARES Act. This is the Coronavirus Aid, Relief, and Economic Security Act. It was passed late Friday, March 27th, and provides relief provisions to individuals and small to medium-sized businesses and nonprofits. This is the act that you've heard a lot about, that is providing stimulus checks to qualifying individuals that many of you may have already received or will be receiving in the coming days, and also loan programs that were large but ran out very quickly for small businesses. This act included several benefit changes that impact group health plans, including retirement plans. For our health and welfare plans, some of the biggest impacts were an extension of the contribution deadline for the 2019 HSA contribution. As you recall, the deadline to file taxes was extended until July 15th, and the deadline generally for HSA contribution is by the date for filing the tax, an individual's tax forms. And that usually is April 15th, but now individuals have until July 15th of 2020 to make their HSA contributions. Additionally, the CARES Act provided coverage without cost saving or cost sharing for coronavirus preventive services for treatment, and it also included a safe harbor for high deductible plans that have telemedicine benefits. So the plan is HSA eligible even if it covers telemedicine before the statutory minimum deductible is met. And that relief is effective until December 31st of 2021. Another significant change from the CARES Act, this is welcome news, I'm sure for many of us. As you may recall, way back, it seems many years ago, with the ACA passage, part of the ACA repealed the coverage of over-the-counter medicines without a prescription. So the CARES Act repealed that rule that took effect in 2011, and over-the-counter medications are now allowed to be reimbursed tax-free. This applies to FSAs, HRAs, and 213D HRAs without prescription. So that's great news for individuals and families. Practically speaking, from a card perspective, even though this repeal is retroactive to January 1st of this year, meaning that any OTC purchases made on January 1st and forward are reimbursable, the card swipes may take a little bit of time. I actually looked this morning, and I am seeing some of the online stores where you can use your FSA dollars actually are showing OTC drugs as being reimbursable without a prescription. But that list used by merchants is in the process of being updated. Hopefully all or most have updated by now. But if you do have an OTC drug or medicine expense and you are not able to purchase it with a card, those claims can still be submitted by paper claim, and they will be reimbursed. Another important legislative act is the Families First COVID-19 Response Act, and this was passed March 18th of 2020. Among other things, it provided two types of leave. The first is an emergency paid sick leave. Both of these leaves related to leaves dealing with COVID-19 related issues, whether someone was diagnosed or had a family member. There were also some leaves for school closures. But Part 2 extended FMLA to provide emergency type leave related to COVID-19 issues. And these are both effective 4/1/20. Initial guidance when this came out, the date was 4/2, but there was a guidance subsequent that changed the effective date to 4/1/20. So both of these leave laws apply effective 4/1/20 to employers with fewer than 500 employees. Another provision in the Families First Response Act that applies to our health and welfare plans is the coverage of COVID-19 testing without cost sharing. This was a requirement. It included preventive or COVID-19 testing as a preventive service, and also clarification that the coverage of that testing without cost sharing does not impact HSA eligibility. And just as a reminder, we also have the CARES Act that extended the HSA eligibility where you have telemedicine options. I do want to remind you about mid-year deadlines. These are not new and are deadlines that we have yet to receive updates for. So I want to make sure they're on your radar. The first is the PCOR fee. And I know many of you thought that this was a thing of the past. We too thought that until late last year, early part of this year. But part of the 2020 Appropriations Act, which is the budget legislation, was to continue the PCOR fee. So the PCOR fee is extended through plan years ending before October 1st, 2029. So the deadline for filing and paying these fees for plans, self-funded plans, including HRAs, ending during the 2019 calendar year is July 31st, 2020. And we will be reaching out to you all with more information on that and how we will assist our HRA clients with that fee in the coming days. But know that that is a deadline that is out there. If that deadline is extended by the government, we will certainly update you with that information. The second mid-year deadline is Form 5500 for calendar year plans. These are our 1/1 employer groups. These filings are due also by July 31st, 2020. There is an automatic 2.5-month extension available if an extension form is filed with the IRS, and that extended deadline would be October 15th of 2020.
Thanks, Laura. I want to say a quick word about the great job that Laura, John, and their team that includes Scott Littleton and Kelly Turner do on 5500 preparation. We prepare 5500s for several hundred employers all over the country, and these guys do a great job with that. And this is kind of the busy time for Form 5500s approaching the calendar year deadline. And appreciate the good work those guys are doing. And if you have a Form 5500 need, whether it's a question about whether you need to file or a question about what this requirement even means, their team will be happy to help you. Shifting from the what's new to what's going on right now with employers part of the session, by my count, today is day 37 of the quarantine period. And if day 1 was the first day that schools were canceled, here in North Carolina where we are. Today is day 37, and a lot has happened in those 37 days. I'm sure a lot has happened with your organization and your people. From the perspective of our team, not just our compliance team, Laura, John, and myself, but also our account management team, our tech team, our sales team, the questions that we receive run the gamut from employers, and we work with employers of all sizes and of all types of situations. But of the practical questions that we've gotten from employers and advisors on a daily basis, most of those questions fall into two categories. The first category is benefit elections, and the second category relates to eligibility. Whether someone is continuing to be eligible or someone may have lost eligibility, or what happens if someone's status has changed because there's been a change with the organization and the way that employees are going to be handled during this time, whether it's a short time or an extended time, that business will be handled differently. Let's start with benefit elections. First of all, I want to draw the distinction between when we talk about elections that are made for a particular plan year, and just for purposes of example, let's use a calendar year plan. That employer went through open enrollment for the calendar year 2020, and elections made by employees, whether to participate or not to participate, generally apply for the plan year. The distinction I want to make is between pre-tax elections and post-tax elections. For elections that are paid with pre-tax dollars through the Section 125 plan, and that's an area we assist many of you, both managing the Section 125 plan and making sure there are legal documents in place to protect those tax savings. Any election made and paid with pre-tax dollars is, generally speaking, locked in for the year. And unless there's a loss of eligibility or unless there's a qualifying event that would allow a change, changes are not allowed for the pre-tax benefit. Common question we've received from employers: such and such employee X is still working, but their hours may have dropped a little bit. They're still eligible for the plans. We're paying them less. Is that a qualifying event for them to drop medical? Well, the answer to that under IRS rules would be no. Even if the person's making less, if they're still eligible for the plan, they haven't had any kind of change in eligibility, they haven't had a reduction of hours that would put them into part-time status, then there's no qualifying event. A reduction in income by itself is not a qualifying event. So because of that, the default is that the employer does not make that change. That's an example of a pre-tax mid-year analysis for an election. There's a difference with post-tax benefits, benefits that are either paid in full by the employer or are paid by employees with post-tax dollars. An example would be a supplemental life policy, or for many employers, a short-term or long-term disability policy, or an individual supplemental benefit. The qualifying event rules under IRS regs in Section 125 do not apply to those benefits. So if a person wants to drop that coverage or reduce that coverage mid-year, hypothetically, the person can do it if the employer allows. And then, of course, the carrier may have a policy on what mid-year changes are allowed. But just want to make that distinction that the IRS rules around qualifying events only apply to pre-tax benefits. So the default with our benefit elections in effect in this example for the 2020 calendar year are those that were made for the year and paid with pre-tax dollars. Those are the only ones that are locked in. Now, if there's a qualifying event and someone is moved to part-time or someone goes on leave, which I'll talk about in just a moment, then that is a qualifying event. The person could reduce or drop coverage as a result of the qualifying event. Whereas if someone, for example, goes from 40 hours to 32 hours, but they're still eligible for the plan and the employer contribution to that benefit, there would be no qualifying event. So the default is that the employer would not allow that employee to make a change if they wanted to. Question: has the IRS announced any special relief under Section 125 for the current health crisis? And the answer to that is no. Whether such relief could come, we don't know, but we're not anticipating that. So we think that employers ought to follow the Section 125 rules, and that's what we're recommending. Would an occasional exception be understandable under the current environment? Yes, potentially, and maybe the risk analysis has changed, but our recommendation, our advice to employers is let's continue to follow the rules best we can, even during this time. One thing we have seen in the last 2-3 weeks in various states is that some carriers have allowed a new special enrollment period for April, and maybe the same will be true for May, that the carrier, let's just say for health insurance, has allowed the employer to offer to employees a second opportunity to enroll if the employee had previously declined coverage, for example, for 2020. And so the questions come from employers: if our carrier is allowing the special enrollment period, can we both allow people to add coverage, for example, for 4/1 or alternatively for 5/1, and pay those premiums with pre-tax dollars? While IRS rules do not specifically allow a provision for a second open enrollment, it is our analysis that since the carrier is allowing it, and given the current state of affairs, that the employer could allow a second opportunity for an individual to enroll in the health plan and to pay premiums with pre-tax dollars. That analysis includes both technical and practical considerations, but we think that would be an allowable change for employers. Whether or not that type of special enrollment option will exist beyond this month, we don't currently know. We're relying on what we're hearing from employers and advisors, but we think allowing such a mid-year change addition of coverage would be allowed. Other benefit election issues come up in the context of the benefit plans that we administer. For example, FSAs. Question from participant: I elected an FSA for this year. I'm contributing on a monthly basis. Given this situation, can I increase my election? Unfortunately, no. There's not a qualifying event to increase the election. Similarly, there's no recognized qualifying event right now to reduce an election if there's been no change in eligibility status. Separately, dependent care FSAs have been a popular topic of discussion. What if the individual had elected a dependent care FSA amount for 2020? For the first couple of months of the year, it worked as the employee intended it to work. They were paying for child care, get to save taxes by getting reimbursed on a tax-free basis. But once the quarantine period starts, stay at home, schools are canceled, daycares are either closed or schedules are adjusted or costs change, can the person drop a dependent care FSA election and reduce it? Answer: yes. While the health FSA, much like the pre-tax elections for group health, dental, or vision insurance, are fairly restrictive, the dependent care FSA allows for qualifying events in a number of scenarios, including a change in the availability or a change in care. So if an employee has not been paying dependent care expenses, for example, from March and April because the children are not in daycare anymore, or the employee is not working, the employee's at home, they don't need the daycare for work-related purposes, that employee can make an election change to reduce or drop the dependent care FSA election. On a separate but related note, health savings account elections, as many of you may know, that allow your employees who are in a high deductible health plan to contribute to an HSA bank account on a pre-tax basis, even if the employee election and bank account contribution is deducted from pay on a pre-tax basis, there's a special rule for health savings accounts that election can be changed prospectively on a month-by-month basis. No qualifying event is needed. So if you have any employees that have made an election for contributions to an HSA bank account, but they want to change that, an increase, a decrease, or a reduction to zero for any month, that is something that the employer can allow. Laura and John will look at some of the questions if there are any we haven't gotten to that relate to benefit elections. We'll come back to those. Moving on, for the second category of questions that we're receiving from employers and advisors, in addition to current benefit elections, all seem to relate to eligibility. Is employee X still eligible for this benefit, or how do we handle employee X's election or payment of premium for any eligible benefits? Now, we've heard a lot of words in the current health crisis relating to employees, and some of those words are furlough or layoff. Some of them relate to leave, and then, of course, as Laura mentioned, the FFCRA included a couple of new situations for paid leave or for extended coverage under the Family Medical Leave Act. But regardless of the situation, in our view, when we talk about benefits, not employment law, which is not our area of expertise, but just how to handle benefits, we think that every one of these situations relates to one of three categories. One, the employee is still active. So even if the schedule has changed, even if hours are reduced, even if compensation has reduced, the employee is still active and in many cases still eligible for benefits. Or in certain other cases, the employee is still active, but maybe they've been reduced to part-time. And this would be whether they're still working on location or they're working from home. If there's been a change in status so that they have been reduced to part-time, but they're still active and still either eligible or they've lost eligibility under a reduction of hours. The second category is leave. And for situations that employers are calling furlough or even layoff, but the person actually hasn't been formally terminated from employment, I would say that those situations are, for benefits purposes, a leave of absence. The leave might be paid, partially paid, it might be unpaid. It might be an FMLA situation due to a serious medical condition of the employee or an immediate family member, or it may not. It may just be a work-related decision. Either way, that is a leave situation. So when an employer says to me, we put an employee on furlough, how do we handle their benefits? I'm going to ask more questions. Okay, you say furlough, is the person still employed or not? And if they say yes, then I say, okay, let's talk about this as a leave. Or we've laid this person off. Okay, are they terminated? Yes or no? If the answer is no, okay, we're talking about leave. If the answer is yes, then we're talking about termination of employment. That's this third category. John will address that in a moment, including whether a matter is subject to COBRA or state continuation. Let's take these one at a time. First of all, I'll start with active status. When the person is still actively employed, again, as I mentioned a moment ago, there's no change in eligibility unless the person goes below the hourly threshold for eligibility for any one benefit. So if the person remains eligible, even if hours are reduced, even if comp's reduced, but they continue to work the hours to remain eligible under the benefit plan, the employer may elect to maintain the status quo, and that would be the default. The employer might choose to pay less or more for coverage. Employers can elect to modify contributions or benefits, can add benefits mid-year. You can take away benefits mid-year. You can add contributions. You can reduce contributions. Employers have the right to do that. We're not necessarily seeing a lot of that yet. If this situation drags on very long, we might see more of that. But the employer does have some options, with the default being that status quo remains the same. And for the active, eligible employee, they continue to be a participant in the plan. They continue to have eligible premiums that the employee owes, deducted either on a pre-tax or a post-tax basis. The employer continues its contribution level. Assuming the employer continues its same contribution and the employee maintains eligibility, there's no qualifying event, everything stays the same. If the employer is in a situation where it has to reduce contributions, the employer has the ability under the law to do that, but the employer should also know that may trigger qualifying events. For example, if the employer's normal policy is to pay 80% of group health insurance coverage for the employee-only coverage, and the employer, due to the health crisis and business considerations, has to reduce that from 80% to 60%, the employer can do that mid-year, but it would create a qualifying event so that the employee would be able to either reduce or drop the election. But otherwise, the key for someone who's still in active status is, are they still eligible based on the hourly requirement? If so, status quo is the default. If not, if they drop below the hourly requirement, then we have to assess, okay, do we need to terminate them from benefits and potentially offer them COBRA or state continuation for a group not subject to COBRA? And we'll come back to that in a moment. A quick word about best practices. In every case, as we assess eligibility, whether for an active employee, whether for someone on leave, or whether for someone whose coverage may need to be terminated, we always need to keep in mind the foundational elements of benefit law that apply even if there's not a health crisis. And that means, first and foremost, that whatever the plan says goes. Whatever the plan says is the law as it relates to that plan. For example, if the health insurance plan, summary plan description, SPD, which is the carrier booklet for participants unless the employer has implemented a wraparound summary plan description. If the plan SPD says that eligibility is for anyone who's active and full-time with a regular weekly schedule of 30 or more hours, and the employer decides that it wants to extend eligibility even for those that are working less than 30 hours who may be working from home or on an alternative schedule remotely, if the employer wants to do that, the employer may be able to do that, but it's going to have to consider, in the SPD, it's going to have to make sure it's cleared that with the care if it's a full insured plan, or the TPA and stop loss care if it's a self-funded plan. The employer can't just make an eligibility change that goes against the SPD without clearing those hurdles. So what the plan SPD says matters and controls, and the employer, as the plan sponsor, as reflected in the second bullet point, needs to make sure that eligibility is administered accordingly and consistently with the SPD. Without going into too much detail about the Affordable Care Act, for health insurance only, which is all that the ACA applies to, any employer that's an applicable large employer needs to consider the ACA requirements. And other employers that may even not even be subject to the employer mandate as applicable large employers need to consider that there are ACA rules. For example, question recently from an employer that we think one area we can cut costs but still be able to offer the health plan in 2020 as we make business changes would be to say that spouses and dependents are no longer eligible. And we're going to cover employees, but we're not going to cover or pay for anyone else. Can the employer do that? Answer, no, because the ACA requires that any health coverage offered by the employer, group medical coverage, must be offered to the employee, and the employee must have the option to cover a dependent up through age 26. Spousal coverage is not legally required. There's some other considerations there, but you can't make dependents ineligible and still comply with the ACA. That's just one example. And the final best practice matter, bullet point 4, is that we always need to make sure we're following the terms of the carrier contract. And the example would be my 30-hour illustration a moment ago. We need to make sure we know what the carrier contract says so that if we're going to make any changes mid-year, that we do not go against the carrier contract and jeopardize any claims or any eligibility issues and stop-loss coverage we may have there. So that's a brief word about active status and best practices. Now to leaves of absence. This is the second bucket. So again, for every employee that has not been terminated from employment, they're either active, they're either active full-time, active part-time, or they're on a leave of absence. Leave of absence is a big and somewhat intimidating topic for employers, and that is evidenced by the fact that many times when a leave issue comes up and one of the questions asked of the employer is, do you have a leave policy? The standard answer is no. So if there's a leave policy, fantastic. We want to make sure that benefits are addressed according to the leave policy. Premiums are paid according to the leave policy. If your organization doesn't have a leave policy, that's something you should certainly consider. From an employment perspective, a leave policy is recommended. Stepping away from the employment side and just looking at it through the lens of benefit elections right now, when we assess how benefits should be handled for someone who's on a leave, and again, this could be a paid leave or an unpaid leave. It could be FMLA or non-FMLA. It could be called furlough or layoff by the employer, but any situation where the person is still technically employed by the employer and not yet terminated from employment, we're going to treat it as a leave. Now, in a normal scenario, leaves don't come up that often, and when they do, many of them are FMLA related or they're medical related or person related. The big change in this health crisis is that a lot of the leaves are employer initiated, such as what we're hearing called furlough or layoff. The employer sends people home and says, we're not terminating you. We're going to try to weather the storm. Yes, you may be eligible for unemployment, but we're not going to be able to pay you for this period, at least this period of time. Recommendation regarding benefits is, first and foremost, communicate clearly with the employee. Let the employee know what kind of leave it is, what the timetable is, at least the minimum timetable, or that the leave is indefinite, and how benefits will be handled. Which benefits is the employee still eligible for? If the employee owes premium payments for one or more of those benefits, how the premiums will be handled. For example, if the employee is not going to be paid during the leave, but the employee is going to remain eligible, for example, for group medical coverage, and the employee owes, for example, 20% of the premium that would normally be paid on a pre-tax basis from the employee's paycheck, how will the employer receive that payment? The standard would be, it would be treated almost like COBRA, state continuation, that the employee during the leave needs to pay the employer with post-tax dollars by check, for example, that portion that the employee owes for coverage. And if the employee doesn't pay that, the employer would potentially have the opportunity to terminate the employee from coverage. The employer is not required to front the money and pay for the employee and then collect it after leave, but that is an option, and many employers will end up doing that in this health crisis for people on leave, particularly if the amount owed by the employee is not very much. The employer may just continue paying the full premium and then collect what the employee owes via pre-tax deductions once the employee returns to work. But of course, some employees may not return to work. That option may not exist. So employers want to think through their options there. But there are options regarding payment. There are options regarding collection. And at the end of the day, to answer the question, are we required to cover premium payments for all of these folks on leave with the expectation we may not collect them? No, the employer is not required to do that. There are some options and opportunities. But again, it needs to be clearly communicated, because one thing employers cannot do, for example, is not communicate clearly to the employee how the premium should be paid, and then when it's not collected after 1 month, terminate the employee from coverage, even though the employee was never fully apprised of his or her options for payment. That would not be a legitimate approach for employer regarding those premiums. The standard period of leave is 12 weeks, and we say that because FMLA is 12 weeks. Most employers that have a leave of absence policy that allows a person to remain eligible during inactive status, that inactive status for benefit eligibility typically expires after 12 weeks, 13 weeks, which would mirror the short-term disability standard period, or 3 months, which is just a little neater and cleaner than using 12 weeks or 13 weeks. So most plans, not all, but most plans include language in the plan SPD that says that if a person becomes inactive due to a leave of absence, and this would encapsulate a number of things, FMLA, short-term disability, workers' comp, that eligibility will continue for, again, 12 weeks, 13 weeks, or 3 months. Now, what that says to me for benefit eligibility is that once the person goes on leave, we can leave them eligible. We can either charge them or not charge them the premiums they owe, but we cannot leave them on the plan while they're inactive forever. We can only allow them to stay on for that period. And if they don't, for example, come back within that period, whether it's 12 weeks, 13 weeks, or 3 months, we have to terminate them from the plan. And then if it's a COBRA benefit, offer COBRA. But we can't keep them on forever. At some point, we've got to start the COBRA clock, because if we just leave someone inactive, eligible in the plan forever, and then it becomes a claim situation, the carrier investigates and realizes, well, we should have terminated them at some point, that's going to be a problem for us, either under with the carrier, claims paid, or even the stop loss provider if it's a very high claims situation. There are a number of other things related to leave. We do have some separate training materials, both in writing and in webinar format. In the interest of time today, we're going to leave that for, no pun intended, leave that for now and move on to the next topic. And John's going to jump in here to talk about termination. But the final word of advice for employers is, for any of these folks that are on paid leave or unpaid leave, whether we're calling it furlough, layoff, or some other better name we've thought of that makes an unpaid leave sound good, let's make sure that we know where we stand for them regarding eligibility. We know where we stand regarding how the premiums will be paid. We communicate that clearly to them. And then if and when they return from leave, we've got the roadmap of how we're going to handle premiums and eligibility. For example, if someone goes on leave, that is a qualifying event. They could choose to drop coverage in some circumstances, but if so, and they return to full-time work, we're going to need to offer it to them again. and decide whether we're going to make them serve the waiting period or not, which is not legally required, but the carrier may require it. Alternatively, if the person goes on leave and is continuing the coverage, either by employer decision or employee decision, they want to continue the coverage, then when they come back from leave, that's not going to be a qualifying event. They're going to have to continue the same election they've had during the leave. There's not going to be an opportunity to make that particular change. The general rule of thumb is the start of leave is a qualifying event, but if a change is made, then a change can be made when the person comes back. If no change is made at the start of leave, no change will be made when the person comes back. And in the situation where someone loses eligibility by termination of employment, or they go on an extended period of leave and either the employer decides not to keep them or the employer has to terminate coverage, then we're looking at a termination situation that John will describe.
Thanks, Jason. As Jason mentioned, after all of these other options, if termination of coverage has happened, then generally we're going to be speaking about COBRA for the most part, and then I will talk a little bit towards state continuation, which is sometimes referred to as mini COBRA or state COBRA. But the same general policies apply regarding termination of coverage, as do active coverage as well as leaves of absence. You want to know what the documents state for each benefit and ensure that the coverage, or the termination of coverage rather, is administered consistently with the document, whether it be the SBD or the carrier contracts, depending on what type of plan it is. But and again, all of the same applicability applies here with the ACA and insurance carriers regarding that the documents are going to be your official guideline for what and how the benefits are administered, either actively or after termination through COBRA. Because COBRA, as we all know, COBRA is simply an extenuation or rather an extension of the benefits that they have that they were eligible for. So you want to make sure that you're administering them consistently so that those former employees are treated with the same rights as the active employees with regard to the benefits and eligibility. As a reminder for COBRA, it does apply to all group health plans, which we have in quotation marks there because group health plans does not necessarily mean medical coverage. It may include dental, vision, other benefits like telemedicine, depending on how those are set up in the plan. And a reminder that a COBRA eligible benefit, there is a limited set of triggering events that apply, but COBRA must be offered within 44 days. These things have not changed under the current health crisis, so you want to make sure that you're aware of those. And please, don't forget your resources here. Reach out to your account manager if you're unclear about whether an event has triggered COBRA. If you're not sure between the transition from leave of absence to a terminated employee or whether an employee has technically been terminated, reach out to your account managers here so that we can assess the situation for you and try to help determine whether that triggering event has actually occurred in order to generate the election notice. The IRS and the Department of Labor have not changed any of the notification requirements for COBRA, so you still have to send an election notice, and we will make sure that you get that sent out in a timely fashion. But in order to do that, we have to know that the event has happened. So we would rather you ask us ahead of time whether an event is triggering than assume it has not been a triggering event and carry on as is. As a reminder too, COBRA, the length of COBRA has not changed. Typically it is an 18-month extension of benefits unless there are special extensions, disability determinations, second qualifying events. I won't go into details on those because those are unique situations after COBRA has applied. But then also, as you'll see in the asterisk there, the employer still does have the option to assist with premium costs, just like they do for active coverage and leave of absence coverage. The the cost of COBRA is generally transferred to the employee to pay, but that is not a requirement if the employer wants to assist with the premium cost to help some of those employees who may have moved into the termination scenario and be offered COBRA. Briefly here, as well as on state continuation. State continuation is, as I mentioned earlier, sometimes referred to as mini COBRA. It generally applies to employers who are not subject to federal COBRA, and those do vary from state to state. And sometimes the state continuation for COBRA simply says we follow the federal guidelines. We just want to do it for employers who don't meet the standard for federal COBRA. As a quick reminder, federal COBRA applies to any employer with over 20 or more employees. And so the state continuation simply wants to make sure that coverage also applies to smaller employers. But as mentioned on the slide there, a lot of times it may only apply to medical insurance and not to all benefits. So, check with the state laws, and if you have questions about your state laws, we're happy to help assist with those. But generally, as a COBRA administrator, we are only and primarily focused on federal COBRA law, but we are happy to try to point you in the right direction if you have questions about any state continuation. Most state continuation also does not supersede federal COBRA law because it only applies to groups, plans that are not subject to federal COBRA. It generally cannot supersede any federal law. So if you are subject to COBRA and you have COBRA questions, the federal guidelines are going to be the ones that apply, and those are obviously the ones that we administer for the most part. But we are certainly glad to help where we can or point you in the right direction if you have specific questions on state continuation and its applicability.
John, you've mentioned that employers do have some flexibility in terms of if they have to terminate someone either because the person doesn't come back from leave or the person they just terminate them outright because of the current situation, that they have the flexibility to pay all or part of COBRA for as short as 1 month or as long as 18. Can you speak to whether there have been any Department of Labor extensions on COBRA deadlines for payments or any other changes?
Glad to, Jason. This is a question that comes up frequently because of all of the various extensions. For example, the IRS has extended the tax filing deadline to July. So a lot of folks are looking for relief where they can. And a lot of participants particularly have been asking whether there have been any extensions. There have not been any changes in the Department of Labor guidelines to COBRA payments or to any COBRA allowing notice requirements. The laws there, and to our knowledge, there are not any intentions to make these changes either. Obviously, since COBRA is an extension of existing benefits and someone has to pay those existing premiums, just like you, the employer, are paying premiums for active employees, someone has to pay them for COBRA. So in order for the carrier to get paid, the Department of Labor has not extended any deadlines for payment. As a refresher on COBRA payment deadlines, it is generally due at the first of the month, and there's a 30-day grace period to make those payments, which we generally help folks go to the end of the said month that they're paying for, and that has not changed. So we are really trying to encourage folks to continue paying COBRA as they can, and unfortunately there is no financial hardship scenario that the Department of Labor has currently released to allow any additional grace or any extension of that payment period through COBRA, which, as I mentioned before, is apparent because the carrier still needs to be paid in order to cover any costs associated with claims under the benefit. I think that wraps up all of our topics there. I'm going to turn it over to Laura briefly here. We're about out of time for the webinar. If you have submitted questions, Laura's going to answer any that may be applicable to many people listening. So Laura, if you want to hit any of those, and then as I mentioned at the beginning, we will be sure to reply to all questions directly if we did not get to them during the webinar.
Thanks, John. Two questions that I've seen frequently. One is in regards to the extension of the FSA or HRA plan year. This has come up where an employee might have scheduled a procedure at the end of the plan year and had that particular appointment canceled because of the crisis, and how can that be handled? There is no rule that allows the plan year to be extended beyond 12 months currently. So we're encouraging employers encourage your employees to submit other expenses that they may have that they have not yet submitted to try to use up, especially those FSA dollars. If it is an FSA account and there's a carryover, that will help some. If they can get their balance down to 500, they'll be allowed to carry that $500 forward. The second question that we've seen frequently relates to vitamins and supplements and how that is impacted by the repeal of the OTC prescription requirement. And I just want to say that vitamins and supplements still require a letter of medical necessity or a prescription. They are not considered over-the-counter drugs or medicines. And John, I think that puts us at our time, and like you said, we'll respond to the remaining questions that have been submitted.